Hey, what's going on, guys? It's Cody back with Modern Options, where I'm trying to help the average investor just learn a little bit more about options. In today's video, I'm going to be talking about a mistake that I made that I hope none of you have to make, and it was all because of the pattern day trading rule. So first, I'm just going to look at the position that I have on today, and I've put on a put credit spread on the SPX right now, and I did this in the morning sometime around 10:13 or so, and let's see, what levels did I buy it at? I had sold a 43.40 put and bought a 43.35 put. I had done this because it looked more of a bullish day. All of the sectors were looking pretty green with the exception of one, the utilities. And just based on the chart, we had a pretty big gap up in the morning and then just continued to trend throughout the day. So I didn't want to risk putting any upper side to make it an iron condor, so I just did a put credit spread. Took in about 45 worth of credit for a $500 risk. But I put my stop limit at 2 times the premium, so at 90 cents. So if I get stopped out, I'm only losing 45. So it's looking pretty good today that it should expire worthless. But for today's video, the reason why I want to talk to you about is I suffered a max loss on a 0 DTE trade. And it was totally preventable and something that I shouldn't have done, knowing that I had an account that was under $25,000, which is subject to the pattern day trading rule. So let's go back over here to June 14th. Let me zoom out a little bit and make it a little wider so we can see all of the legs I put in here. All right, so I'm gonna take this off for a second. The day started out pretty neutral, not overly bullish or bearish, had a little bit of a gap down and continued to trend down a little bit. That's why I was comfortable making the call side so close so I could have sold more premium in the beginning of the day. I had a pretty generous gap on the put side for my iron condor. I opened the trade about 10:13 a.m. and sold the iron condor for 75 cents. And it continued to be a great day for this iron condor. And throughout the day, it was looking like it was going to expire worthless, but it just continued to have this little bit of a trend down. So I wanted to try something new with the strategy where I would roll down my call side. And I had 3 day trades to do this. So I felt pretty comfortable knowing that I could have sold out of 2 different positions and I still would have been fine because I had another day trade to spare if I ended up using 2. So all the way until, what time was it? Let me remove this drawing. So I rolled my call side down at 1:46 p.m. I went from 42.50 down to 42.45. And then I rolled my long side down as well. So it was a 10 wide spread. I rolled each of the sides down 5 strikes, and I only took in an extra 20 cents in credit. Hindsight, should not have done that and should have just tried to close out the position. It was still looking good at this point. I had taken in some extra premium. I was feeling great. I was going to be able to close it out early, and I wanted to because I saw it start to trend up right here. But when I went in to create a closing order, I was not able to because it said that I would have executed more than 3 day trades within a week. And I figured I don't understand why I did that because I've only opened and closed 1 trade so far. I should still have 2 remaining. But maybe I did something wrong, or maybe I didn't use the rolling function correctly. But when I decided to roll down my short leg and my long leg of the call side, it counted each of those opening and closing orders as 2 separate day trades. So in order to close those again, I would have to execute 2 more day trades, which would be 4 in 1 day, which is obviously more than 3 within 5 trading days. So at this point, I literally couldn't do anything unless I wanted to trade out of it and just not trade for 90 days and save the capital that I had. But I didn't want to do that because I believe I could make it back if it suffered a max loss. So I literally had to just sit there and watch my position keep going higher and higher towards the max loss. And what happened during power hour this day? We had the biggest green spike all the way up to literally go right over my long strike. Just the icing on the cake to make it that max loss. I believe on the day it closed at 42.55 and like 10 cents or 15 cents. So it was just enough to consider it a full loss. So that one really hurt, and I will definitely not be rolling any time soon, especially if I'm under $25,000 account. I was hoping to maybe only suffer maybe 400 or 500 loss, but it ended up going the full width of the 10 strikes to make it a full $1,000 loss. But since I took in 75 cents on premium in the first one, and when I rolled it, it took in another 20 cents. So that means I at least took in 95 cents worth of credit. So my actual loss was $905. Still hurts really bad. And if your account's under $25,000, don't even bother trying to roll any sort of zero DTE trade. The trade that you put on at the beginning of the day is gonna be the trade that you have, whether you close it or decide to let it expire worthless. All right, guys, that's the main topic of this video today. I just wanted to help you to not make the same mistake that I did, because it's one that could have easily been avoided. Just, I got a little bit greedy at the end of the day, wanted to try something new, and it honestly was not worth it for that extra 20 cents of credit. So if this video was helpful to you at all, please leave a like and subscribe if you have not already. A lot of my viewers are not subscribed at all, some like 90% of my viewers. So make sure to hit that subscribe button, it really helps out the channel, and we'll see you in the next one.